A stock jumps 18%, gets halted for volatility, and there is no confirmed deal anywhere. That's Workday last week. Here's what the options chain is actually telling you. What's up, guys? Coach B here. This is the breakdown. Quick reminder, this is education, not financial advice. I am not telling you to buy or sell anything, and I am definitely not telling you whether a deal happens. Do your own research. Workday, ticker WDAY, runs enterprise software, the HR and finance systems big companies run payroll and planning on. Boring, sticky, profitable. And last Thursday, it turned into one of the loudest names on the tape. On August 12th, Workday closed at 175.29. The next day, August 13th, Reuters reported that the private equity firm Silver Lake was in talks to take Workday private. The stock closed that session at 206.45, up almost 18% in a day. And intraday, it went further than that. It spiked all the way to a high of 227.49 before it came back on volume of about 16 million shares, roughly 4 times a normal day. It got so violent, the exchange halted it for volatility. That is the market repricing a company in real time on a headline. Now, here's the part you have to hold on to because it is the whole trade. This is a report of talks, not a signed deal. The number being thrown around, about $43 billion, is a reported valuation of the company, not an official price anyone has agreed to pay per share. As of this recording, no deal has been announced, and both sides have stayed quiet. So the market is not reacting to a deal, it is reacting to the odds of one, and you can see the doubt immediately. By Friday's close, the stock had already slipped back to 198.68. It gave back part of the pop within a day. When a stock runs on a takeover rumor and then leaks lower, the market is telling you it is not fully convinced. So let's read the chain. The nearest monthly is September 18th, about 32 days out. Look at the implied volatility. It is sitting near 50% across the money. For a big, steady software company, that is high. Workday does not normally trade with 50% implied vol. That elevated number is the market charging up for uncertainty in both directions. Here is what that costs. The at-the-money straddle, the September 200 call plus the 200 put, runs about $24.91 combined against a share price near 198. That is the options market pricing in roughly a 12.5% move up or down between now and September 18th. The chain is not betting on calm. It is bracing for a resolution. Now look at where the crowd is reaching. The heaviest call open interest overall actually sits below the price, down at 175 and 180, but that is likely older positioning from before the rumor hit. What is new is up above the stock. The biggest block of call open interest above the current price sits at the 210 strike, more than 2,000 contracts. Traders there only get paid if Workday pushes above 210. That is positioning for a confirmation pop. Someone betting that if a deal is announced, it gets announced at a premium. And that gap is the actual lesson today. It is called merger arbitrage. When a company might get bought, the stock usually does not jump straight to the rumored value. It settles at a discount below it. That discount is the market pricing 3 things at once. 1, the chance the deal never happens. 2, there is no confirmed price yet, so nobody even knows the real premium. And 3, time, because even a real deal takes months to close and your money is tied up the whole way. And unlike a signed merger, there is no clock on this one. A confirmed deal comes with a closing date you can price against. A rumor does not. The next real marker on the calendar is Workday's earnings on August 27th, which could either fuel the talks or pour cold water on them. Until something is announced, the chain is pricing a maybe, not a win. So how would different traders even look at this? A day trader is watching the halts in the 50% vol because that is where the fast money lives. A swing trader is watching the gap between the pre-rumor price down near 175 and wherever a real premium would land. And a long-term investor is asking the only question that actually matters here. Does a deal like this even close, given how much debt $43 billion would take to finance? None of that is a recommendation. It is just 3 different clocks on the same stock. So let's bring it home. 1, a takeover rumor moves a stock on the odds of a deal, not the fact of one, which is why Workday popped and then leaked. 2, when implied volatility jumps to 50% on a boring software name, the market is pricing a big 2-way outcome, not calm. And 3, The gap between the rumored value and today's price is not free money. It is the market's estimate of everything that can still go wrong. If this helped the way you read a takeover headline, subscribe because I break down the next name on the board every time one lights up. Drop your questions in the comments and I read them. Good luck in the markets, no matter what stock you're into.